Hi, my name's Andy Day. I'm the founder and CEO of Capital A, and welcome to M&A Q&A. So today we have Charlie Thompson. Charlie is a marketing exec, having been an account director at McKenna Erickson in the 90s and VP of Bates Pan Golf in Dubai, then a managing partner at BBDO for nearly 20 years. Charlie has since been a consultant at Brave Bison and Engine Group, both of which have had a fairly public M&A strategy. And perhaps we can go into Charlie's experience there in more detail later. Now very much a cybersecurity expert too, as a partner of a capital investment firm focused on digital security, and ANO, a digital security startup. So Charlie has a couple of feathers in his cap. He's also been engaged in a roll-up ANDNOTOR this last couple of years, the roll-ups of several fast growth digital agencies. And there Charlie is partnered with Claire Hungate, and she's the ex-CEO of Brave Bison. And their aim is to acquire growing businesses and unite them in a supersized global 360-degree social content studio and media network. Say that one when you're drunk. I'm keen to bring Charlie in today to discuss his journey through the marketing agency and media world, and also his experience in creating this roll-up, as he's got some great insights to share on building a big, hairy, audacious goal. So there's lots of tips there on private equity, and also we're going to talk about some doing valuations for fast-growing marketing companies and also the egos that go with them. Charlie, welcome. How are you doing?
Very good. Thank you very much. That's quite a flattering intro, Andy. No pressure.
So we're going to kick off with a quick background check, Charlie. This is what we do for all of our guests. So if you can just get us back there in the, is it the 90s?
Yeah, well, yes, it does make me sound really, really old.
I thought the 90s was fairly recent, but yeah.
Yeah, well, there you go. I thought you were referring to the 1890s, but there you go. Look, my career is really one of, yeah, I mean, it's passion and then luck, I suppose. I'm not a graduate. When I was 15 or 16, I was watching ads on the telly and thought I'd like to make them. And, you know, with all the verve and, you know, irreverence of an 18-year-old, I thought I could conquer the world without being a graduate. So I would be able to charge into any ad agency I wanted to, only to be refused by every single one because I didn't have a degree. Wow. Which then I probably put a bit of a chip on my shoulder, I would imagine, because it kind of turned me into a living challenger brand, and you know, someone who just wanted to prove this kind of infrastructure wrong. So in the end, I actually ended up working at a great ad agency. I walked in and said, I'll work for free, and they said, yes, all right. And it kind of went from there. And from that position, I guess, you know, it's funny, I was doing some research in my first job for a company in Norfolk who wanted to create something called a pasta sauce, and that pasta sauce then became Dolmio. So you know, it kind of went absolutely full circle. And I've been very lucky that you know, in all of the agencies that I've worked with, there are two things that have kept me, just been the real drivers for me. One is the people and the culture. I think probably a lot of us are in situations where our primary asset is human, and our primary level of effectiveness and success is the impact we have on other humans and their abilities or their non-abilities or their you know, their propensity to have their points of view shaped by messaging and storytelling. Which for me is very exciting and remains very exciting today.
Yeah, well, it's good that you should mention that, actually. So we've been doing this for 10 weeks now, 12 weeks in total, but these calls for 10 weeks. And I think the sort of recurring subject is that we're dealing with humans, and that's the thing that keeps coming up. So it's interesting that you should mention it as well. So just taking you back, Charlie, back into those early days again. You spent an early part of your career in Dubai.
Yeah.
I've been to Dubai, and it's a fantastic place, but very fascinating and very alien in lots of ways. But what was it back there then?
It was an incredible place, because Dubai, for those of us that have been or have worked there, is a city which isn't finished yet, and it never will be. And it was when I was there. And you kind of go there and you go, this is going to be something incredible, but no one knows when. But it seems to be incredible in the moment when you're there as well. If I were to go back there today, as with so many of our own personal experiences, it's not the place it was, and it's changed so much, etc., etc. From a marketing point of view, though, it was fascinating, because in a country where 3/4 of the population is expatriate, the opportunity for brands to build relationships with consumers is interesting on one level, very difficult on another level, because what you find is that those expatriates are transient. So they're only going to be there for 2 years or 3 years. And therefore, the work that you're doing, the marketing work and the marketing services work, is really much more transactional and much more about selling, and much less about storytelling and building relationships between consumers and brands.
Right. And what happened to that company you were at there? Were they acquired, or did you?
So when I went there, there was an agency there called Pan Gulf. It was bought by Bates, which at the time was owned by Bacchus Spielvogel Bates in the States. Bates was then bought by, I was going to say WPP. At some point, it was eventually bought by WPP and consumed into WPP. Right. And it's still there. The agency is still there. Yes, absolutely, it's still there.
Well, they've still got a profile on LinkedIn, so they must still be.
Yeah,
there.
yeah.
And then after that, I suppose this is probably the biggest part of your legacy, really. So you moved to work at AMV and BBDO, and you were there for nearly 20 years.
Yeah, and having said I was an embodiment of a challenger brand, you kind of go, what on earth are you doing at Abbott Mead Vickers for 20 years? But you know, Andy, that within that time, and part of that 20 years is selling to agency startups to BBDO. So whilst I ended up in Abbott Mead, and if you want to, we can talk about the 2 startups and the transactions involved in selling those businesses. Yeah, whilst I did end up in Abbott Mead Vickers, it was never an agency that I wanted to go to. But I found when I got into that agency something that I wasn't expecting and hadn't seen from the outside, and that is the it's a recurring theme, I guess, but it's the misattribution of arrogance for pride, and what on the outside looked like a big, arrogant, very successful business was actually inside a very, very small culture based around people who were very proud of what they were doing. Right. And having talked about human asset at the beginning of this conversation, the reason I stayed there so long was because here was a business that understood that its primary asset was its people and really knew how to look after their people. And so you end up staying a long time.
So, I mean, just taking into consideration what you said about not having that education and sort of coming into the agency world from the left field, how did you actually make that leap into this big agency? And was that as part of one of these acquisitions?
Yes, so I started up. I was at a smallish advertising agency called Clark and Taylor. I was running, and we had a big piece of Sainsbury's business that Abbott Mead Vickers wanted. They wanted that business, and we did a deal whereby I was close enough to the Sainsbury's business to know that if I started an agency and spoke to Sainsbury's and said, I'm starting an agency, it's going to be backed by AMV and sold to AMV. Will you bring your business with me to new agency? My hunch was they'd say yes, and they did. Right. And that's what happened.
So how did you do that deal then? How did you know that was?
So the deal was very curious and very unlike, I think, many things that will occur today. So I was actually approached by AMV to say, look, we want the business that you're running. Would you come to AMV as an employee? My response was no, I won't just do that. And we set up the agency, and it was done on a 3-year earnout. So there were 4 of us that owned 100% of the business on day one. And we were bought out over 3 years. And obviously, at the end of that 3 years, the business became 100% owned by AMV BBDO.
So you invented SPACs almost.
Well, in a way, yeah, it's quite weird, isn't it? It is quite weird. And the weird thing is that a year and a half or 2 years into that earnout, I went and did it again with another client that BBDO wanted. So there was some learning there that was replicable. And
I mean, there's loads to learn from that if we dig into it. But what's the sort of big tip that you can give us from that?
I think I have 2. I think I have 2. One is, and yeah, I'll give you the caveat at the end, I guess. One is, if you're going into an acquisition and you own something, be really, really 100% sure that all of your partners want the same thing. That's really important. I say that, I'll explain that a little bit. There were 4 of us that owned this business on day one. There was an age gap. There were 2 of us that were old, two that were older and 2 that were younger. At the time, unbelievably, I was one of the younger. We wanted a long-term, yeah, thanks. We wanted a long-term career. We were building something for the future. This agency that we were selling, we wanted it to have legacy. We saw a real gap for an agency of that size within BBDO. The other 2 were older and wanted to cash out. And therefore, the year 3 of the earnout became a year of conflict, because 2 of the partners literally just wanted to book as much revenue as they possibly could in year, did not want to invest in the business for years 4, 5, and 6. 2 of us did. And then you get into a whole argument about what should we pitch for, what should we not pitch for, and that becomes a big issue. And point 2 is obviously related, which is the point about, in my view, are earnouts really the right vehicle for building long-term businesses where partners and management are really engaged? And my view is no. They incentivize for a short period of time, but the goals are pretty much all short-term. And your cash out price is based on short-term goals. Right.
So that's interesting. Actually, I don't think we've had that idea floated in any of our conversations, but obviously it happens a lot, and you do hear about it a lot when these earnout situations go wrong. When there's a team that's inflating the final year of their revenue so that they can get the biggest earnout possible. But obviously, once they leave, and I mean, the work can often end up being very poor, or you can't complete it, or for whatever reason.
Or it compromises your client relationships.
Right.
Because actually, and I have experience of this twice in companies that I have set up and sold, and I have witnessed it in earnouts in other companies that I was involved in but didn't have equity position in, that actually all of a sudden, because depending on the length of the earnout, but let's talk about a 3-year period, for instance, in the final third of that period, you're literally trying to, or in my case, literally trying to drive as much income from those clients as you possibly could in that year.
Right.
And therefore your status or your goal in those relationships where you want to become a trusted advisor becomes fundamentally compromised.
Yeah. And so, having been through that a few times, if you were in that situation again, where that was your agency and you had people doing an earnout, how would you prevent that from happening in future? Advice.
Well, it brings us on to the roll up that you know, we're working on right now, which is you know, find a vehicle, choose your targets, acquire 100% on day one, whether that is through 100% cash, preferably not, but certainly a cash and a very large and motivating equity stake, which is open-ended. That I say it's open-ended to a large degree. That's defined by where you get your funding from, and what the investor timeline is, and when they want their money out. Yeah. But keep it open-ended.
Okay, so that equity stake is where, in the company that you're acquiring, or in the top co?
In the top co.
Okay, cool.
Yeah,
that's a good tip. And I think we've seen that sort of Martin Sorrell style as well, I suppose, a little bit, because he's giving big chunks of equity, at least.
Exactly. And he's also, whether he's doing them publicly or privately, he's doing welcome bonuses. And critically, and I think this is important, is that you still provide, you know, large in-service performance bonuses to founders as well, and actually to all members of new target companies.
Okay, so that's again some good tips. Everybody get that? I can see Will's writing it down. So just before we go on to that roll-up, because I do want to get into that in a bit more detail, I just wanted to talk a little bit more about your leadership roles, because I think looking at your LinkedIn in particular, very much your years at AMV are sort of defined by you being a leader and part of the management. So can you give us maybe a bit of your experience in that role, and the success that you had as being a leader at an agency? What was that?
Tell me if I'm not getting granular enough with my answer. I will be quite general. I talked several times already about our primary asset is a human asset. As a leader, therefore, in my view, and I'm a disciple of someone else's opinion by saying this, you care about two things, and you only need to care about two things. One is quality. So being the best you can be, and I don't mean as an individual, but obviously I mean as an individual, but I also mean as a business. The quality of your product is critical. Caring about quality is the platform and the bedrock on which your business is built. But the other thing, and the only other thing you should care about, is each other. If you care about quality and each other, everything else falls into place. In a business where we're dealing in human capital, as a leader, I have viewed my role as being someone whose job it is to create the environment in which other people can thrive. Leaders in people businesses have to be altruistic, right, and ultimately altruistic, in my view. It's interesting that if you mentioned SPACs, if you look at 100 SPACs in the States, those that have been the most successful are those that have been run by operators, not by financiers. And those operators are obviously the people who understand not only what the business is doing, not what services the business is providing, but also understands the importance of the people within the business. Mm-hmm. You know, hard metrics are a byproduct of soft metrics in a large degree.
Okay. Yeah, all right. Interesting that you mentioned SPACs. We did refer to them before, but which of the SPACs are you watching out of interest?
Oh, look, I mean, it's a minefield. You know, what is a SPAC? You know, S4C is arguably a SPAC. Yeah. You know, so I am watching that with interest. But you know, the way that you know, the likes of WeWork can find you know, safe haven from all the trauma and the trials and tribulations of SoftBank finance and, you know, close bankruptcy is fascinating. I'm watching the really, really large scale SPACs.
Yeah, there's a lot to learn, I think, for M&A enthusiasts
Yeah.
in general around the whole SPACs discussion.
But also the legislation around SPACs and how SPACs in different countries work in very different ways and have very different thresholds. You know, where SPACs in the States are raising, you know, upwards of 500 million to 3, 4, 5 billion. SPACs in Canada are designed much more for small acquisitions and startups. Yeah. Which is very interesting. The SPAC business in Europe is obviously relatively immature, but our financial services authority regulations around SPACs here make SPACs more difficult.
Yeah, they're changing that though, aren't they? That's something that we're working on, because we want some big celebrity-sized SPACs there in London. So yeah, they're changing the way that it works so that we can accommodate. Okay, cool. So look, let's get on to where you are a little bit more up to date. So, so after the big AMV thing, you left there. I don't know whether you left to do something bigger, or did you want to take a break, but what happened?
No, it may dovetail into the answer of what you might be asking me next, which is, you know, how do you get to what you're doing now? And that does feed into the reason why I left AMV. What I found about big marketing services organizations, I was the ultimate, was I a gamekeeper turned poacher, or the other way around? I'm not sure. We spent a lot of time figuring out how we could make the agency more digital, provide digital services to our clients. My observation is that all of these big marketing services groups make those decisions as a defensive measure, not as an opportunistic offensive one. Ultimately, they're trying to protect the base of, you know, the revenue base, which comes from 1+ cover television, and has with it a cost structure that cannot deliver against the key drivers of digital marketing, which are obviously fast, good, cheap. You know, we always used to say, in a pre-digital environment, pick 2, but you definitely can't have all 3. But we on this call are all dealing in an environment where you must be able to deliver all 3. And therefore you must have a cost structure that allows you to do that. And so, it was time to move.
Right. So you're, I mean, one of the big things when we were doing the pre-call to this, we were talking about having no legacy in the agencies that you're aiming to roll up now. So I guess that was the thing that was pissing you off in AMV, is that you just wanted to get away from that high cost structure in the background so you could deliver great digital work.
It wasn't pissing me off. It was really, was there really the opportunity for the kind of growth that I wanted to personally be involved in that environment? And the answer was no, because there were businesses being started up all around me that were driving off the back of an opportunity in digital that were growing very fast organically.
Right. Okay, so after you left there then to look for something that would work for where you wanted to go, you did a bit of work at Brave Bison. You work as a consultant there, I think, and then obviously you've I don't know if you knew Claire Hungate before, but Claire's the CEO, was the CEO of Brave Bison, I think, at the point where you went there to be a consultant. Can you tell us a little bit more about that? And then was that the moment, were you thinking about this idea there with Claire, and did you come up with this idea?
So Claire, I had met Claire a couple of years before she joined Brave Bison. She was just leaving Warner Television. She was the chief exec of Warner Television. She'd done a whole bunch of roll-ups and acquisitions within television production space. And she and I kind of came together off the back of a similar insight, which was there were audiences that were gathering around content and entertainment properties in vast numbers, completely organically, that marketers hadn't figured out how to engage with, because marketers were still buying audience and still paying quite a lot of money to buy audience. So whether you hold huge value in 1.5 billion views of a piece of 15-second film that appears on your Facebook feed, however often, with a Lad Bible tag on or not, it doesn't really matter beyond proving that large audiences will gather organically around something that's entertaining. And that has to be an opportunity for marketers. And that's where Claire and I kind of got to.
But Brave Bison's arguably very good at that already. So,
well, what Brave Bison was doing was creating platforms and channels to host and create that audience, but they weren't particularly good at properly integrating brands and marketers and advertisers into that, because the business model of Brave Bison, Lad Bible, et al. Is you can call it a one-legged stool if you want, and they're trying to build other legs, but it's fundamentally built on ad revenues. And if Mark Zuckerberg wakes up tomorrow and says we're not having that, he calls it visual chewing gum. If Mark Zuckerberg doesn't want visual chewing gum on his platform anymore, he cuts the legs out of all of those businesses. And so all of those businesses were trying to diversify. And part of the role that I had at Brave Bison was self-identified, because Claire joined Brave and we had a conversation, which was, how can we meaningfully diversify this business into much higher margin services, as well as ad revenues? And that's where the idea for ANDNOTOR came from.
Right. So you guys were together for there, and then I think there was, I don't know exactly how it happened, but there was a group that came in and bought a large share of that business, didn't they? And took
Tangent. Yeah, it was a floated, it was a publicly quoted business, or it still is a publicly quoted business.
But they've got a majority share.
Tangent acquired a big chunk of shares.
And so they took control of the board, I suppose. I don't think they fell out with Claire at all, because I spoke.
No, that acquisition was after Claire.
Right.
So no, Claire had left before that acquisition.
She left already. Okay, so
yeah.
you guys left before Tangent got into Brave Bison, and it looks like they're doing some great work over there and very ambitious. So once you guys are not in Brave Bison or not involved in that, you've got the opportunity now to do your own roll-up. So let's get to that exciting stage.
So
what's the plan? What's the plan?
So the plan was, how do you build a roll-up around, or how do you build a marketing services group around audiences that are already somewhere? Okay, so my career, Martin Sorrell's career, and his career today is actually built around building a marketing services group, which has at the center an exchange of money for creative services. Okay. Mm-hmm. Ours was not put that at the middle. Ours was put audience at the middle, right? So if you put audience in the middle and you go, where are audiences gathering? What services would you put around those audiences that could then properly allow brands to interact with those audiences? So it's kind of the other way around. And therefore what you get is, or what we got as a strategy was, first of all, you put something that's creating content and getting large audiences, and you join them up with a business that can grow those audiences, but give you an additional revenue stream straight away. So our concept was that would be a channel publisher like a Brave Bison, and you'd put an influencer marketing business on it. So you're taking the ad revenues from your content, but now you start bringing brands in through influencer marketing, and the influencers by definition will grow your audience even more and therefore grow your ad revenues. What you then do is figure out, okay, so how else do we engage with audiences and with brands? And then you get into social community management, then you get into creative advertising, then you get into podcasting potentially, you certainly get into program making, and you move all the way around the services and the entertainment properties And you look at your brand video publisher at the middle and you go, what if I've got 1.5 billion people watching 38 seconds on my food channel and they're doing it twice a week? That's a huge number of people. Why wouldn't I try and create a 15-minute or a 30-minute TV show that I can sell to Netflix, which might only get 10 or 11 million, but that's still a huge number and that's still monetizable. And once you've proven that, you then repackage it and you build a bigger channel and you sell that to another TV publishing property, another platform property. And then you can get into live shows, and then you can get into ticketing, and then you can get into merchandising and e-commerce, right? So if I shortcut the whole of that process, you go, audiences are gathering around something. Actually, brands will now be, in the future, brands will be created by what audiences want, rather than brands being created and then pushed onto audiences.
So is part of that strategy to create products and sell directly to that audience, or is
ultimately it absolutely could. One of our targets was for 2 seasons, very, very successful, creating merchandise off the back of channels that they had that were pulling over 1 billion views a week.
Right. So it's almost like the industrialized version of sort of YouTuber influencers that are kind of operating as one-man bands, like Mr. Beast or somebody that can pull in those big numbers and sell merchandise and sell tickets.
Absolutely right.
Sell hamburgers, but you're going to get that model and then stack it up basically.
And scale it, and basically scale it, because
okay.
the value is in scale.
So that's the whole 360-degree thing. I'm very, very interested in that model as well. I'm very, very, very passionate, and I know you and Claire are as well. But just getting back to the M&A side of the stuff that you're talking about.
Sure.
So what was the plan around the finance part? 'Cause I know like finding the funding is often like the scariest part for entrepreneurs, particularly like creatives. They're thinking, how the heck do I get hold of all this cash? Because I want to roll up these multi-million. I know you were aiming at some really hot big social media agencies that probably had lots of people interested in at the time. So where do you get the finance together? And obviously you've had experience in big companies, so you've been closer to the big pots of gold previously. But what was the plan there, and what's the plan around?
So the plan for us was to fund through private equity. We asked that you asked me at the beginning about the deals that I'd done on earnouts and what was the learning from that. And the answer, don't do earnouts. So we were establishing a topco. The topco would take investment from private equity on a 3 to 5 year return. We were looking for 50 million to fund 3 acquisitions. And those 3 acquisitions would value 150, because we were doing 50% cash, 50 equity in Obviously, the roll-up of those first 3, we were very careful in selecting what those 3 targets were, and to ensure that there was plenty of headroom for client growth in all of those 3. So even though many of them were working with brands already, it was really important for us that they weren't overlapping in their client lists, so that we could take services from one to the next, to the next, to the next, and drive revenues in topco that would see very, very fast returns for our widening shareholders. Claire and I would dilute over time, and at the 5-year point, there would be an exit, whatever that exit might be. Right. Over the 5 years, the plan was to make about 9 or 10 acquisitions. Right. There would have been another fundraise halfway through the 5 years.
How much would that be for out of interest?
The second fundraise probably would only actually have been about 25, 30 million.
Right. So I know you were out speaking to private equity. I think we met about 18 months ago, maybe 2 years
Yes.
ago.
Yes.
So it was obviously trounced by COVID, but the plan is still in place. But can you just tell us a little bit, because I think this is really of great interest to the guys here, is how do you approach private equity? How does that part work? Do you need a business plan and a smile, or how do you go about private equity?
It is very interesting, and I will tell you that before we started on this particular journey, my experience of turning up to private equity with an idea was pretty close to zero. So I didn't know. The answer to your question is, we approached people we did not know within private equity. We approached them directly. We did bring advisors on board once we had opened a number of conversations, but critically, we had our targets identified already.
Right.
And not only had we our targets identified, our targets had expressed a willingness and a real openness to go through with this deal. And so we didn't go in with a business plan on day one. We went in with a concept. We teased them with the concept to get in the door. We told them that we had our first targets. Pretty much that was enough to get us in the door of pretty much anywhere we wanted to go. When we actually went in and got people under NDA, because clearly you're not under NDA when you're making that first approach, which was why we didn't talk about targets and we didn't talk about business plan. Once we got people under NDA, which was usually early on in the first meeting, we would then talk specifics about the concept, about the businesses. The concept that we had was very, very well received. The targets that we had were even better received because their joining together was going to be big news. Mm-hmm. COVID became an issue, but one of the other things that was really interesting to us was how private equity, and I don't want to be quoted on this, so this better not get in the edit of the podcast, the fickleness of private equity and the cycles that it goes through about what it's looking for at any one time. So one of the things that was very interesting to private equity was that we were taking businesses that had grown very fast off the back of ad revenues, but our concept was all about mitigating and future-proofing them by moving away from ad revenues as the primary source of growth and developing multiple revenue streams.
Right. So you were bringing quite a lot of experience, obviously, to very young companies. And I suppose that was the attraction you had to be able to bring that deal to private equity as well. The experience and, well, it's the experience mainly, isn't it, that you guys were bringing to very young new companies. But what was the plan? And we'll go on to where you're at with this at the moment. But what was the plan then, once you'd made those two massive acquisitions, in terms of the sort of closing stages of that playbook? Were you looking to exit the business in 3 years to a larger private equity group or IPO? What was the deal?
We had, there are a couple of things involved in this. One was one of the clear insights in doing this in the first place was that these businesses that we were acquiring were started relatively recently, 5 to 6 years, by young guys or girls who'd had great ideas, who had got them up to between 5 and 10 million revenue pretty quickly, but had no idea where the next 5 or 10 was coming from.
Right.
Didn't have the experience of how to scale a business, didn't have the experience of how to become trusted advisor partners to and play in the C-suite of large FMCG client organizations. For we did have that, but we weren't ever going to be doing that forever. At the 5-year point, it may well be the position that actually our principles of our targets are now operating at the level that we were five years ago, if you see what I mean, on day one of the deal. Did Claire and I have a view that we would 100% make an exit after 5 years? No, we didn't. But the exit plan would have been one of 3 things: IPO, larger private equity, or trade sale to one of the marketing conglomerates.
Right. Okay, cool. And we just right at the top, we touched on sort of the, having to deal with these very big egos, particularly, I suppose,
Yeah.
they're no worse in creative and marketing people, but certainly they don't tend to be wallflowers either. So how have you managed to deal with, those founders? And also, I think the other thing that's attached to that is the inflated valuations that come with that. How do you deal with that part of it when you're trying to get these deals landed?
Yeah, and so much of this is about the ability to build personal relationships and having a point of view on the world. We were lucky that the founders of the businesses that we wanted to make our platform acquisitions had turned away a lot of other investors in the past. Because they didn't share a worldview about the way that brands would build and the way that marketing services would develop. Fortunately, we did. And that helped to balance out the ego issue, right? And I don't want to overplay this point about ego, but when you start a business and it grows really quick and you're 24 years old, you think you can conquer the world and you think you've done it. One of the founders of one of the businesses that was going to sell to us, over breakfast one morning that I had with him, and he was thinking about exiting the business, he looked at me and he said, "Charlie, I'm 28 years old and I'm nowhere near as rich as I thought I'd be." Right? And that was a business that was turning over 18 million quid. So he didn't know how to go from 18 to 50. And he knew and was getting immensely frustrated about his personal lack of ability to do that. And he knew that he needed someone else to help him do it. So the ego point is maybe a bit of a misnomer, but it's kind of a false sense of security. I've done this, I built this business really fast, it's doing really well. I should be able to now completely cap it out and at a huge number. And they were pretty much basing their valuations on multiples of revenue rather than really getting into the nitty gritty of EBIT.
Right. Yeah. And I think a lot of people new to M&A do really, they come at it at the wrong angle and think it's about revenue.
Yeah.
And obviously revenue can be full of lots of costs that aren't even your own that you're passing down the line. So it's interesting that they were making sort of fundamental errors on valuations, should I say. I just wanted to touch on something that you mentioned there, because I think this is a learning point as well about platform businesses, because this is very much the sort of structure that private equity do acquisitions and build roll-ups. Could you tell us a little bit about just this sort of the strategy that you would have to go and do this roll-up and where you begin with that? So what you acquire first and what that platform business is and how then you do
yes.
the bolt-on strategy after that?
Yes. So it really for us, within the context of the idea that I've outlined, it really for us was about making an acquisition first and foremost of a business that was already creating content and engaging with audiences in very, very large numbers. Because for a business that's selling a concept to private equity about our point of difference is that we're driven by audience rather than anything else, you kind of have to put your money where your mouth is and make that acquisition first. But you have to convince private equity that that business is scalable. And the only way for us to be able to do that was to show them that the scalability would come from add-on services. Okay. If you look at a business like Jungle Creations, for instance, who obviously have a lot of great platform channels, they're drawing in huge audiences. They have, within the last 3 years or so, developed The Wild, which is a creative services business. Mm-hmm. Has that business actually been successful to the point where it can genuinely sign retainer contracts with clients and with client brands, or is it largely doing project work to create content that then goes out on the network? The answer is the latter. Would it be more lucrative if it were the former? Yes, 100% it would, because it would be a service business operating at high margin. What they couldn't do was create a link between the wild and the services the wild could offer, and how that would further motivate the audiences channels. And to do that, we needed to bring in other disciplines as well. Influencer marketing was going to be really important on day one. Not the management of influencers, but the arbitrage of influencers, and using them, if you like, as the analogy is using them as commercial airtime. You know, buying commercial airtime through influencers rather than buying commercial airtime on ITV1 or E4.
Right.
And the reason you do that is because it augments the offer, and it embellishes the audience that are engaging with your channels. And then the strategy develops into what other services do we then need that we can then sell to the clients of our two platform businesses. And then it moves on from there.
Right. And I think one thing I will say, Charlie, which I really admire, is just the size of this deal that you've gone for right at the start, with 50 million setting your targets. What was it always going to be that big? Or, I mean,
you know, well, first of all, it's too small for private equity.
Right. So
that's another really interesting thing. And Robert, when I came onto the conversation, I heard you talking about a roll up that you're involved in. Walking into private equity and talking about making acquisitions and asking for 50 million was a challenge, because they wanted businesses that were, sorry, I say 50 million, I'll reframe it. Going in and talking about businesses that were operating at between 2 and 4 EBITDA was too small.
Right.
You know, a number of them told us to come back when we got 15 million EBITDA businesses. And as we all know, in this sector, there are probably only 2, and we weren't going to be able to buy them.
So you had to tailor the pitch to your audience and actually scale the whole thing up and go for the big.
Yeah, we had to demonstrate scale and return very quickly. Since we've been doing this, the concept has been proven by the performance of the targets that we've had in mind, because their growth in the last year has been in excess of 100%.
Yeah. Yeah, so I do know who you're talking about. So yeah, they've done very well, I think.
Yeah.
So just sort of, we're coming up to the hour. So do you want to tell us whereabouts you are now with this deal? What's the plan now? So you've had a bit of a setback, but it's definitely.
So very, very quickly, very quickly, as we're coming up to the hour, we got kiboshed by COVID. Our timing, or its timing, couldn't have been worse. We were about to do a deal, COVID hit, advertisers ran for the hills, so ad revenues completely dried up. So a business then that was that's first revenue stream was based on ad revenue was a non-starter at the time for private equity. However, now that not only ad revenues have climbed up, but audiences in and of themselves are so significantly greater online than they were pre-COVID, the level of interest from private equity is actually higher than it was when we first went out. The question for us is now actually more about where do we want that funding from geographically. Pre-COVID, we were very much in London, and actually now we might not be. We might be much more in the States, more in Asia. Even though our targets are based here, actually the vast majority of their audiences are in Asia or in the USA. So it might be more appropriate for us to take funding there. And those are the conversations that we're having now. The concept is still pretty much the same. The roll-up is still the same. The targets are different, and the funders will probably be different.
Okay, so nothing's really changed in terms of the strategy, but you're just geographically looking in different places. And it's interesting you should mention Asia as well. So I know that's of interest, and we'll probably get some questions around that in a bit. So thank you very much for your time, Charlie. Can you just kind of very quickly, before we open the floor, where we can find Charlie Thompson with ease?
Oh God. So I can send you I'm obviously on LinkedIn. and I've taken all your names as well. So let's all link in after this, and we can message that. I'm on charliebt@me.com by email.
Brilliant, old school. charliebt@me.com.
Correct.
Okay, brilliant. Thank you very much. Very enlightening conversation. I'm sure we've got a few questions. So if you'd like to open your mics, if you're looking to ask a question. Robert.
Yeah. Hi, Charlie. When you're looking at target companies, are you just looking for really good businesses that fit a criteria, or are you looking at how they would gel with other companies in the roll-up specifically?
100%. Yeah.
And then on top of that, do you encourage the group to work together for growth? So like cross-selling, and we've had sort of conflicting ideas from different people about this, and it's to me it kind of makes sense to get them all talking as a way of growing. But yeah, I was interested to know how you manage that.
So when we went out and in conventional buy and builds, you obviously that you can go out and get a corporate advisor to represent you, to go out and find all your targets, and to another one to help you find the funding, and you sit there and wait till they've brought something to you, and then you can go away and operate it. We didn't do that because, as I've labored the point, all of our businesses are human capital businesses. And so culture and individuals are very, very important to us. So we did all the research on targets ourselves. When we then saw the work they were doing and had spent a fair amount of time subtly checking out the personalities that were involved in those businesses, then we would approach them and try and meet with them. Getting into their numbers was a secondary conversation, but their willingness to be part of a group was important. We promised everyone exclusivity in their field. So we were not going to go out and buy 2 social community management businesses. Right. We were not going to go out and buy 2 ad agencies. That might change over the 5-year period, but that would be a joint decision. To answer your second question, there were 2 boards of directors, 2 boards within our holding company group. One was a strategy board, which is the board of principals. So the board of directors of ANDNOTOR group would have had the principals of the target businesses sitting on it. Right. There was secondarily an operations board, which is about how you get these people working together. All of these companies are motivated by the share price of the group, not of their own companies. So they're incentivized to work together. Yeah. Very, very directly. And that was baked into the business plan.
Yeah.
And we then had a very clear strategy for how we would develop growth across those companies. And actually, we had agreed that we would appoint one of the founders of one of the first targets actually as our chief growth officer, because he was just so good at pitching business. So yes, we would absolutely incentivize them. But that again comes to the point of earnouts. To me, earnouts do not incentivize group growth.
Right. Yeah. Brilliant. Thank you.
Will.
Yeah, well, it's really good, really interesting. Thanks very much, Charlie. And there's probably 100 questions here, but some of them are actually quite a bit granular. I wasn't quite clear when you said that you went to the private equity and the EBITs of some of these companies weren't 15 million, right? That was what they wanted. So how did you overcome that?
It was a binary point, Will. I mean, either we had 15 million EBITDA companies, which we didn't. If we didn't, those PEs walked away.
So
it was completely binary.
So eventually you found the private equity that were happy to invest in the profile of the businesses as you had it.
Yeah.
And when you started your conversations with the targets, at this point you didn't have a platform business. At some point, you just you started effectively with nothing but with a vision, and then you would take these, essentially the targets, you had a sort of note of commitment or something to the private equity. Did you find that you could get the targets on board with the vision alone, or were they interested? They must have asked you.
An egg is clearly something you've experienced. We had a concept. The research that we did first was on the sectors that we wanted to form our platform, right? So our our video publishing business, our influencer marketing business, those are the sectors we researched first because they were critical to the idea, right? They had to be our first acquisitions. We approached them before we approached PE. And when I say before, I'm literally only talking 10 days before. So there wasn't a gap of months that we had to sit on our hands and not answer the "where's your investment coming from" question. Okay, so as soon as we had NDA signed with our targets, we would go straight out to PE, get PE under NDA. We would have memorandum of understanding from our targets. And obviously we were then trying to get memorandum of understanding or letter of intent from private equity very early on. But in all cases, we had agreements that we were allowed to share our private equity conversations with our targets that would allow them to open their books to us.
In that process that you've described, at what point did you get to evaluation then?
With those first two businesses, pretty much at the first meeting. And I say, you say evaluation, I say the founders of those businesses told us that these conversations would not be worth having unless we could get them 100 million quid. We chose to ignore that information and plow on anyway because we knew we were never going to get them 100 million quid. But through relationship and through a diligent process, we were going to get them to a point where they could more realistically assess their own valuation, which is pretty much what happened. By the time we were close to signing PE deals, we had slashed valuations by 50%.
So they liked your vision of the company, but they didn't like going through that process, I don't suppose.
No,
they were reasonable. It seemed reasonable because private equity was essentially determining their value in the market, was it? Or?
But no one else was blowing any smoke anywhere near them to say we'll give you 100 million quid or whatever the number was. Right? They did not have. They were not the honeypot that bees were circling at that number. There were bees circling, but we also were very. We were lucky, clever, whatever. We were able to find out what valuations those other people that were interested were putting on those businesses. And you do that through grapevine, and you do it through network, and you do it through other, through contacts, and contacts and contacts and contacts. And that's where corporate advisors really become very useful because they know who's talking to who. Yeah.
Could you just run past me that 10 days business thing? You went 10 days from between what and what? It was between.
So it was. I was just saying that rather. So you asked, at what point did our targets say where's the money coming from? Mm-hmm. Yeah, we did not have to wait long before we could tell them that we were in live conversation. So it was literally we'd be approaching targets on day, let's say on day one. A week and a half later, I was making calls to private equity with the concept. And with the fact that we had opened conversations with two really meaningful targets.
So this whole deal process was very short then, really?
In theory it might have been, but in practice, no, it was actually going to be quite long because as soon as you open the conversation, both of those conversations, targets and PE, were about gauging interest.
Okay.
Interest was high at first meeting.
Yeah.
There are then still obviously a whole load of hurdles to go through as you develop.
But at that point, the deal was on, and everyone was trying to work to get it to happen, I guess. Yeah.
Subject to due diligence, valuation, and all the legal hoops. Buying out existing investors. There were a couple of corporate investors involved with one of our targets, and we didn't know what their exit conditions were going to be. They had exit conditions based on their early investment, in their earlier stage investment. you know, we won't come out for less than 10 times or whatever the number was.
And I'll nip in a couple of other quick ones, if I may. What were the numbers like in terms of how many targets did you actually approach to get to your? You did 2 in the first round, did you? Was it, or 3? And then what was the ratio on private investor conversations?
So targets, we had 2 targets in mind very early on, having done some research into both of those sectors. It was quite clear that there was a leader in sector A, a leader in sector B. Those are the businesses we want. So the numbers were very small. We went to those leader businesses and they said yes straight away. Private equity was probably 1 in 3 or 1 in 4. And I say that based on a whole number of other issues that private equity would have, scale of the deal being one of them, excitement around the concept being another one, the ability to scale businesses outside of ad revenues. There's some PEs had skepticism about that. Lack of ad tech on day one might have been an issue for a couple of others. Venture capital, we did talk to VCs. VCs wanted to obviously put money into ad tech. We didn't have ad tech on day one. We actually had a position where we wanted to develop our own technology rather than make acquisitions in tech. And so there would be a multitude of reasons why PE would drop away and why you'd get to a 1 in 4 kind of number. And when I say 1 in 4, I mean we got to meaningful signals of interest from 25%.
Mm-hmm. I think we need 2 hours, Andy.
Well, I'm very happy to follow up if Andy allows that kind of thing.
Yeah, of course. No, I just wanted to add something to that, Will, because I think one of the things that I've been talking about, Charlie, is to have quite a big list to start with. And I think from what you said, it sounds like you had a very small list, but having been privy to that experience, I think there's a bit of a conversation just before that, where you were actually speaking to people like me and probably a number of different people to try and narrow down what that list would look like.
Right.
And then that list became much smaller because the targets that you were looking at had to be of a certain value. And actually the number of companies that were in that list got reduced down to a couple, I would say, that you had the choice.
I think we had a very big list. Yes. So no, I mean, you're right. When it came down to who do we want as our first 2 acquisitions, the list was pretty small.
Yeah.
But we actually had a very, very long list because in the sectors that we wanted to go for first, having had conversations with Andy and various others, there were really only 2 or 3 targets that were worth having a conversation with. In all of our other sectors, the lists were very long, and researching who would get on the long list, researching who would get on the short list, researching who we actually then wanted to pick up the phone and try and have a conversation with was a lengthy process, which involved a lot of people.
Yeah, just wanted to make sure that we had that on record.
Yeah, I know. I didn't want to. I think it aligns with what you say, Andy. It does completely align with it.
Well, no, I mean it's interesting because I think what happened with Charlie's search was there was so few that could have fit the bill. Once they start to discuss what they actually wanted, there was very few targets that actually fit the bill with.
Right, yeah, but your principle isn't to doggedly go and ask 100 people, can we buy you for the sake of it? It's more, it's more rooted in this idea of look broadly and
yeah, a little bit.
So the principles behind it that the
and you're also targeting businesses that are likely to want to move ahead with this. So you're giving yourself the best chance of opening a conversation, I'm assuming.
We could open a conversation quite easily with most of the targets that we got to, because part of the research was at what speed have they grown over what period of time, and what level of stagnation might they have experienced in the last 12 months.
Yeah.
And we knew, therefore, that the targets that we were after had slowed down from their first 4 years of trajectory. And so we were going to them almost to say, look, we've identified a problem that we think you're experiencing. here, look, we have an interesting potential solution for you.
Yeah.
And they were up for that. They were absolutely up for that. In the marketing, in the platform business and the influencer marketing business, that was narrow. When you got into advertising agencies, when you got into social marketing businesses, when you got into research data engine businesses, production company businesses, the whole thing became much wider and much more labor intensive, because those businesses had been around for a longer period of time, and their growth had been steady and slow. So we had a blend of slow, steady growth businesses and very fast growth businesses.
It must have been a slight feeling that you, in giving your vision to the targets, there was a risk there to you that you were giving them the vision to go and do that themselves, I guess. Much
yes.
as you would bring a lot to the table, of course, but
yes, that was more an issue for private equity actually than it was for the founders of those businesses, funnily enough, because the businesses had experienced that, or certainly the founders of the businesses had real experience that they weren't necessarily able to do that from a capability and service provision perspective. They were also encumbered by their ability to raise large amounts of funds against the valuations of the businesses that they thought they had. So they couldn't go out and raise 50 million to go off and do it themselves. Private equity, on the other hand, were, well, hold on a minute. Yeah, you've brought us two fantastic businesses. We could go and shove 50 million quid into those businesses, and we can provide the operational know-how to do that in partnership with them and not have to dilute 20% to you guys. So yeah, it was more an issue on the other side.
Okay, brilliant. So just obviously we're well past the hour. So just want to double check, because I know Will's probably got another list that he's writing up very quickly. One more question, Will, or what have you got?
well, there's loads more actually. I think maybe I'll reach out to Charlie and they're quite granular and points of clarity and everything.
Okay,
but no, it was really good. Yeah, I could go on, but it's really good. Thank you.
I'm going to swap out with you next week, Will. I'm just going to leave you to ask the questions. All right, brilliant. Thank you so much for your time, Charlie. That's been really enlightening for everybody here. I think it's been a fantastic experience that you shared with us, and it's been really enjoyable as well. So thank you for everybody's time as well, attending. And same time next week, we've got another call. And I'll send the details, but I'll share Charlie's contact details in the private LinkedIn group, and I hope that you will all get in touch with him and tell him about your agencies and also your M&A experience as well. So thanks very much, everybody. Have a good weekend. I think Capital A are having Monday off so they can go shopping, have a pint in a pub or something. Or
a pint outside a pub.
Outside a pub, yeah. So I hope you enjoy your long weekends, everybody that's engaged in that sort of stuff. Speak soon. Thank you very much.
Thank you.
Thanks, Andy. Thank you, Charlie. Good to meet you.
Thank you, Charlie.
Thanks, Charlie.
See you later, guys.